As we look at the market, which is really a weighing tool between risk and reward, there's a lot of risk, but there doesn't seem to be much reward anywhere these days. Am I wrong?
No, you're right on that, Tyler. And I think one of the things that investors have figured out that compared to what it was 2 or 3 years ago, there is an alternative now.
Yes.
You don't have to be in equities. You can be in cash, where you can get even short-term treasuries close to 2.5%, 3%, and you can be in bonds that can give you 3 to 5%. So for those looking for that margin of safety in a time like this, you do have other alternatives. You don't have to have your cash sitting there idly.
Yeah, no, that is really the case here. Bonds are investable again, both in terms of where their yields are, and if you go in and buy a 2-year treasury at 4+% and you just hold it, you take all of the duration risk out, and you get a nice 4% yield, which looks pretty nice in today's market. You do have a couple of stocks that you think are sort of stable enough, beautiful balance sheets, yields are nice, returns are steady, and they are both in the pharmaceutical area, the healthcare area.
And they are. And Tyler, the other thing to think about stocks like this, Bristol Myers and J&J, which are the two of them, they are not correlated to the stock market in the sense that they're not dependent on what the Fed is going to do with interest rates. They're not cyclical depending on what end demand is for industrials or semiconductors and technology. These are companies that have secular growth. Bristol's 9 times earnings. It's got a huge amount of products in its oncology, immunology, cardiology group. It's got a dividend yield of 3%. It's been out of favor, but guess what? It's up over 10% for the year, and that's because it actually has its own secular growth. J&J, similar story, but is a little more complicated. It's got pharma for 60%, 30% med tech, and 10% consumer, which they're going to spin off. Trade's a little more expensive, close to 15 times earnings, but you're getting a 2.75% dividend yield. The thing about both these companies, their dividends are also increasing over time. Mm-hmm. You want that to keep up with inflation. So while people do go into bonds, remember, inflation is something that people have to worry about their portfolio for the long term. Bonds are good. Think of them as an anchor in your portfolio, but you do need pricing, you do need earnings to grow, and you need dividends to grow, which will keep up with inflation and help you kind of get ahead.
Okay, can I ask you about the cash part, sitting on cash? If you're somebody who's got cash sitting on the sidelines, Sarat, at what point do you think, okay, I need to just go ahead and buy a 2-year treasury with it, just so that the inflation is not killing the value of the cash that I have on hand?
So a couple of things. First, think about the risk profile. If you've been sitting on cash, is it because you were scared of the market? Did you need it for the next 2 or 3 years? If you had cash thinking, hey, it's part of a diversified portfolio, then I completely agree. Buy the 2-year treasury, but you can also buy corporate bonds. That can get you a little bit higher than that as well. But I would only put it in bonds if that's what you wanted to do before. I wouldn't do it to say, hey, I'm going to park it there and then I come back when the market bottoms. We just don't know when that is. But I think putting that cash in there, if you don't need it for 2 years, it's not a bad thing. There are some good bonds out there that you can buy. But again, don't think of it as, hey, I'll sell out of there and try and time the market, because that's one of the hardest things to do.
Where do you think, I know it's impossible to pick the low point in the market, but we're seeing really, this has been a really bad month for stocks. I think the worst since March of 2020, which was, of course, memorable because of the pandemic at that time. Where do you think we are in this sell-off? Are we in the 6th inning, the 7th inning? What?
So I would look at it 2 ways. I mean, look, when the Fed said terminal value is going to be close to 4.5%, that was a signal that, hey, multiples have to come down. Secondly, we are not even through started earnings season, so I think that's going to bring the S&P earnings down. So I think we're close to 7th inning. We've got a little more of a bump to go down just as earnings get rebased. But I'd be selective here. I mean, you can nibble here. It's not a question if you're a long-term investor. But could the S&P break 3,600? Absolutely. And then, depending if you think earnings are going to be around 200 for the S&P, you could get a 32 to 3,400. But that's cheap at that point, because now you're saying there's going to be no earnings growth going forward. So I think you're going to get that opportunity to start now looking at specific companies, and then those that are kind of just taken out to the woodshed because investors are scared at that point.
We've talked quite a lot about how earnings sort of took a backseat to what investors were thinking when they were putting their money to work. I'm just curious, now that you, Sarat, and a lot of our experts who are coming on are saying earnings are very important now. But don't these companies have tough comps against last year? I mean, so many of them, especially in the consumer discretionary space, they had incredible years last year. So when we're looking forward to earnings, they might be on a great path, but compared to last year, it's going to be a struggle.
Yeah, and some of them have reflected it already. I mean, companies like PayPal have already been discounted because they had so much pull in. So I think it's going to be the guidance going forward to say, hey, this is where we think the next, 3 to 9 months is going to be. Not that you want to buy just off that, but if companies say, look, we think things are, better for us, whether it's, in terms of if you look at a Visa, MasterCard, or you look at the consumer part. But I do think, there are no short-term catalysts that are going to make this market go forward. It's only when the market looks ahead 12 months and says we're through the storm. That's really hard to tell. Sitting back here at backseat driving in 2009 and 10, it was, oh, yeah, that's when the markets came back up. But they came back up when earnings were still going down. So we don't know when that trough is going to be. So you just have to be selective and patient and again, be diversified, because if you're going to try and time it and go all in, you could go another 10, 15% down. There's no kind of button that says we're going to stop here.
Sarat, thank you for bringing us some perspective here.